Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamowen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're discussing a recent report from Oxford Economics that suggests Canadian mortgage rates are expected to rise, and housing could remain unaffordable until 2035. While the good news is that Canada has managed to prevent a mortgage cliff that would have increased costs for existing borrowers, the bad news is that the benefits of rapid rate cuts and extended amortizations are only expected to last a few weeks for new buyers, before affordability worsens again. The report highlights that the current landscape of falling mortgage rates and 30-year amortizations might boost affordability in the short term. However, this is likely to be a brief reprieve. As home prices increase and mortgage rates begin to climb again, the temporary affordability gains are expected to diminish. Slower population growth may temper the increase in prices, but a return to national housing affordability is anticipated to take about a decade. Oxford Economics predicts that while affordability might return by 2035 for Canada as a whole, more expensive cities like Toronto and Vancouver could remain out of reach for the average household indefinitely. This long-term perspective underscores the complex challenges facing the housing market, where cheap credit and increased leverage have long-lasting effects. The Bank of Canada is expected to continue cutting rates, with another 50 basis point reduction anticipated in December and several more in the first half of the coming year. By June 2025, the overnight rate could fall to 2.25%. However, this primarily benefits variable rate borrowers, who make up a smaller share of the market compared to those with fixed-rate mortgages. Fixed-rate mortgages are influenced by Government of Canada bond yields, which means further rate cuts might not significantly increase credit capacity in the short term. Looking ahead, the decline in fixed-term mortgage rates is expected to stall at current levels before starting to rise again in 2026. The average 5-year conventional mortgage rate has already dropped by about 100 basis points from its peak in late 2023, settling around 5.4% in October 2024. The forecast suggests these rates will hover here until mid-2025, after which rising bond yields and a slightly tighter monetary policy could cause rates to edge higher. While the prospect of rising rates might seem daunting for borrowers, it also indicates a strengthening economy. Typically, rates increase when inflation rises and economic output is near peak productivity. This scenario suggests that the economy could be performing robustly enough to warrant the central bank throttling credit growth, a testament to the economic dynamics expected in the latter half of the 2020s. Today, we're diving into the challenges Ontario faces in meeting its ambitious housing target of building 1.5 million new homes by 2031. Despite the Ontario government's efforts and commitments, experts say the province is likely to fall short of this goal unless drastic changes are made. The reasons are multifaceted, involving high land costs, rising interest rates, and bureaucratic delays, among others. Richard Lyle, president of the Residential Construction Council of Ontario, points to increased development charges, excessive red tape, and federal sales taxes as significant barriers to the construction speed needed to meet these targets. The Ontario government has set housing targets for the province's largest municipalities and introduced the $1.2 billion Building Faster Fund to incentivize them to meet these targets. However, recent reports indicate that Ontario is not on track to reach its annual goal of 100,000 new homes, with projections falling short between 2024 and 2027. The government's fall economic statement adjusted the 2024 housing starts projection from 87,900 to 81,300, far below the 125,000 new homes needed annually. Despite these challenges, the provincial government remains optimistic, citing the highest housing starts in over 3 decades. Justine Teplicki, Director of Communications for Provincial Housing Minister Paul Calandra, attributes the slow pace of construction to high interest rates and economic challenges caused by federal policies, including the carbon tax. The government is taking steps to address these issues by cutting red tape and streamlining approvals to accelerate the building of new homes. The Financial Accountability Office of Ontario's recent report underscores the challenges ahead, highlighting a decline in housing starts and a particularly dramatic drop in single-family home construction. To meet the 2031 goal, Ontario would need to start an average of 39,900 units per quarter from late 2024 onward, a significant increase from the current pace. Experts agree that a combination of factors like high construction costs and governmental fees are making new builds financially unviable, particularly in the Greater Toronto area. Municipal fees for single-family homes have seen a sharp rise, adding to the financial strain. Approval delays further exacerbate the issue, increasing costs per unit significantly. The Residential Construction Council of Ontario predicts a decline in housing starts and employment until 2025, with only a gradual recovery expected thereafter. The Canadian Mortgage and Housing Corporation reports that Ontario's housing starts have lagged behind the national trend, with a significant drop in starts compared to other provinces. Mike Moffat, an economist with the Smart Prosperity Institute, notes that Ontario's homebuilding rate per capita has been in the lower half of the national ranking for years. This trend could lead to a brain drain as young, educated professionals leave the province in search of more affordable living conditions elsewhere. The housing crisis impacts all residents, not just those trying to enter the market. As housing affordability worsens, it affects the broader economy and quality of life. Richard Lyall emphasizes the need for all levels of government to take action by reducing taxes, fees, and red tape to boost construction. Without these changes, Ontario risks exacerbating the housing shortage and facing increased unemployment in the construction sector. Proposed solutions include lowering development charges, expediting the permitting process, and reforming zoning laws to better utilize available land. These measures aim to make housing more affordable and feasible for builders and buyers alike. The federal Conservative proposal to remove sales taxes on housing under $1 million and Vaughan's decision to cut development charges are examples of steps that could alleviate financial burdens on developers and consumers. Despite the challenges, there is a sense of cautious optimism. The Greater Toronto Area's construction sector has a strong track record of building vibrant communities, and with the right policies, it can continue to thrive. The industry advocates for a supportive policy framework to overcome current challenges and deliver on housing needs. The stakes are high, but with strategic action, Ontario can aim to close the gap and meet its housing targets. The Canadian housing market is gearing up for a significant shift in 2025. Experts are forecasting a seller's market in nearly half of the nation's housing regions, thanks to interest rate cuts introduced in late 2024 that are expected to re-energize market activity. According to RE/Max Canada, the national average residential price is projected to rise by 5%. This uptick is anticipated to occur alongside increased sales activity in 33 of 37 surveyed regions, signaling a wave of renewed interest from home buyers, especially first-time buyers, as borrowing conditions improve. Christopher Alexander, president of RE/Max Canada, notes that while affordability challenges remain, the sequential interest rate cuts and adjustments to the mortgage stress test provide a much-needed break for those aiming to enter the market. However, he warns that a surge in sales, combined with limited inventory, typically leads to rising prices, a trend expected to unfold across nearly all Canadian housing markets. The survey by RE/Max Canada highlights a variety of market dynamics as we head into 2025. It's expected that 44% of regions will favor sellers, including key areas such as Victoria and Greater Vancouver in British Columbia, Edmonton in Alberta, and Halifax in Nova Scotia. Meanwhile, about 33% of regions, including Toronto and Ottawa in Ontario, are anticipated to experience balanced market conditions. Buyer-favored markets like Peterborough, Muskoka, and Haliburton in Ontario will constitute roughly 17% of the market. First-time home buyers are likely to significantly drive market activity in 2025, as reported by RE/Max brokers in 81% of surveyed regions. Many in this demographic are seeking townhomes or bungalows, while move-up buyers are focusing on larger properties with more space. Retirees, conversely, are generally looking to downsize, although Calgary continues to see demand for larger condominiums and villas among this group. Consumer preferences are shifting as well, with 47% of Canadians now prioritizing properties in areas less susceptible to climate change, up 14% from 2024. Confidence in working with real estate professionals is also on the rise, with 62% of survey respondents acknowledging the value of engaging brokers or agents during the buying or selling process. The regional outlook varies with respect to price growth and sales expectations. In British Columbia and Alberta, prices are projected to increase between 3% and 10%, with heightened sales activity in regions like Vancouver Island and Edmonton. Ontario markets are expected to see more moderate increases, ranging from 0.1% in Toronto to 10% in Simcoe County. Meanwhile, Atlantic Canada anticipates price gains of up to 8% in areas such as Truro and Colchester County. Despite ongoing affordability challenges, the lower mortgage rates and new 30-year amortization options seem to be bolstering buyer confidence. Approximately 49% of individuals believe homeownership is attainable, while 40% are contemplating relocating to more affordable neighborhoods. These shifts suggest a dynamic year ahead for Canada's housing market as we move into 2025. In today's rapidly evolving mortgage landscape, artificial intelligence is a topic that seems to be on everyone's lips. Whether you're attending industry conferences or simply browsing the latest news, AI is a recurring theme. While many discussions about AI are filled with enthusiasm, promising efficiencies in email writing, process optimization, and enhanced client interactions, there's an undercurrent of concern among brokers. Questions such as, will AI take my job? And how does AI amplify fraud? Are common in these conversations. So, where do we actually stand with AI in the mortgage industry? While new AI tools are being launched daily, offering functionalities from drafting emails to creating flowcharts, their true impact on the mortgage business remains to be seen. One practical application noted by many professionals is using AI tools like Fathom to summarize Zoom calls. However, these innovations, while interesting, are not necessarily transforming the mortgage sector. The current buzz around AI can be likened to a surfer waiting for an impending storm, with dark clouds on the horizon promising massive waves. For now, the waters remain relatively calm, with AI yet to deliver on its game-changing potential. However, the discussion persists, partly due to opportunistic sales pitches that capitalize on the anticipation of AI's future capabilities. As brokers, it's important not to jump too soon on the AI bandwagon. There are stories of businesses investing heavily in custom AI solutions, only to find these quickly outdated by new developments like the latest version of ChatGPT. The lesson here is to remain cautious and avoid committing to premature solutions that may not stand the test of time. Instead, focus on staying informed and open to new technologies as they develop. Engage in low-cost, low-effort experiments with AI tools to understand their potential benefits. Leverage your professional network to share experiences and insights, which can be invaluable as AI technology continues to evolve. For those who fear AI might replace human roles, take comfort in historical parallels. Just as the advent of the internet and email initially seemed like threats to the broker's role, they ultimately became tools that enhanced the profession. The key is to focus on being a trusted advisor, a role that AI cannot replicate. It's about providing value beyond mere transactions. Today, we're covering a significant enforcement action by the Financial Services Regulatory Authority of Ontario, commonly known as FSRA. FSRA has recently imposed administrative penalties totaling $52,000 against Jaswinder Danoa. This action comes after Danoa was found to have submitted false documents to a lender, received fees outside of her brokerage, and failed to maintain proper mortgage transaction records. These actions are in violation of the Mortgage Brokerages, Lenders and Administrators Act, 2006, and its associated regulations. The penalties were issued as part of a settlement agreement with Danoa. This case highlights the importance of compliance with industry regulations to maintain integrity and trust in the financial services sector. FSRA's enforcement activities are crucial in protecting consumers and ensuring that mortgage brokers adhere to the legal standards set forth by the province. For those interested in learning more about this case or other enforcement actions, FSRA has made these details accessible through their enforcement database. This transparency helps consumers and industry professionals alike understand the regulatory environment and the consequences of non-compliance. This enforcement action serves as a reminder of the ongoing vigilance required in the mortgage industry. As professionals, it's vital to stay informed about regulatory changes and to ensure that all practices align with legal requirements to avoid similar consequences. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder: Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.